Hello again. So this video is all about the accounting equation visual notes, and there are 6 pages total, and they cover vocab, account categories, and example transactions. So let's jump right into vocabulary on pages 1 and 2. Why do all businesses exist? Now, the answer to that is to make money. And of course, you could argue that some businesses exist to provide quality products or solutions for customers. You could also argue that some businesses exist to make the world a better place. And that may be true, but all businesses need to make money. Even nonprofits need to make money to cover their expenses. So all businesses exist to make money so that they can continue operating. And of course, there are some other reasons that they exist along the way too. But accounting has been called the language of business, and it is defined as planning, recording, analyzing, and interpreting financial information. So an accounting system is a planned process for providing financial info that will be useful to management so that they can make informed decisions. Accounting records are organized summaries of a business's financial activities. Inaccurate records can often contribute to business failure. So keeping accurate accounting records is crucial to a sustainable business. Okay, financial statements. These are financial reports that summarize the financial condition and operations of a business. Investors use them to determine if they will invest in a business. Business owners and managers use financial statements to make informed decisions, and other businesses can even use them to determine if they will work with a certain business. So accountants use an accounting system to create accounting records to make financial statements that are used by all these different groups to make informed decisions. Okay, moving on to page 2. We will explore the accounting equation using a service business, which is defined as a business that performs an activity for a fee. So some examples there are a barber, an electrician, a financial advisor. Any business that provides a service for a fee is a service business. We are going to explore the accounting equation using a service business organized as a proprietorship. So what's a proprietorship? Well, that is a business owned by one person. Sometimes it's called a sole proprietorship, and that's why we have a little sole of a shoe there. But proprietorship, sole proprietorship, both terms mean that it's a business owned by just one person. This accounting concept here called business entity, this means that financial information is recorded and reported separately from the owner's personal financial information. So it's very important that even if it's just one person that owns a business, they need to keep those records and that information separate. So they have their personal bank accounts and they have their business bank accounts. And that is an accounting concept called business entity. Okay, so the accounting equation is written as assets equal liabilities plus owner's equity. And the accounting equation must always be in balance. So every time you do a transaction, which is defined as a business activity that changes assets, liabilities, or owner's equity, that's defined as a transaction. So after every transaction, the accounting equation must always be in balance. And another accounting concept here is called unit of measurement. And this means that business transactions are reported in numbers that have common values using a common unit of measurement. So dollars, of course, a bank account balance is measured in dollars, but in accounting, so are paper clips and computers and anything else is reported in dollars. It's not just recorded as 100 paper clips, it's recorded as $2 worth of paper clips. Okay, moving on to page 3, we are going to talk about account categories and then start some example transactions. So our first account category is assets, and assets are anything of value owned by a business. So we've got 4 pictures here to represent common asset accounts. The first one is cash, then we have accounts receivable, then we have supplies and insurance. So cash is not a stack of money on a business owner's desk. Cash typically represents the account balance in a business checking account. So it's liquid. They have access to it at any time, but it is not actual dollar bills. It's an account balance in the bank. Accounts receivable are something of value to us because it means that a customer bought something, but they have not yet paid for it. So it's money we're going to receive, but haven't received yet. And that's what the little "you owe me" is. It means somebody owes us money and will pay us, but hasn't yet paid us. Then supplies and prepaid insurance. Again, all four of those things are things of value that are owned by a business. Next up, we have equities, and these are on the other side of the accounting equation. These are liabilities and owner's equity. So equities are defined as financial rights to the assets of a business. And the first type is a liability, and this is an amount owed by a business. And you'll see the little image here, the little IOU image. It's represented by accounts payable accounts. And that means that we purchased something, our business has purchased something, but not yet paid for it. So it's an amount that we owe to another business or another person. Then owner's equity, this is defined as the amount remaining after the value of all liabilities is subtracted from the value of all assets. And four images here represent transactions that fall under owner's equity. The first one is an investment, and that's if somebody, the business owner or somebody else, wants to put money into the business, that's an investment, and it impacts an account called owner capital, which we'll talk about later. But an investment is money coming in, money put into the business to help the business operate. The second one is revenue. This is money coming in by sales. So money coming in based on a product or a service sold, that's revenue. Then the third one is expenses, and that's money going out for things like rent or advertising or postage or miscellaneous. It can be a number of different things, but those are some examples of common expenses. And then the fourth one is withdrawal. And withdrawal means the owner is taking money out for personal use or taking any asset out, most often money, but taking an asset out for personal use. Now, remember our accounting concept, business entity. That means that the business owner needs to keep their personal records and their business records separate. Withdraw is representing money being taken out of the business accounts and into the personal accounts or into the hands of the business owner. Okay, so the accounting equation again is assets equal liabilities plus owner's equity. And now we know a little bit more about what all of those things in the accounting equation mean. So let's move on to our first transaction. On April 1st, the business received cash from the owner as an investment. The owner put $2,000 of his or her own money into the business. So every business starts out with $0 in all categories of the accounting equation. So it's just now starting out. The very first thing that was done is this owner makes an investment. So what's happening here? Well, cash is increasing. The owner is putting money into the business, which means the cash in the business goes up. Also, owner capital increases because it's over here under owner's equity. That investment account is owner, capital, and that falls under owner's equity. So we've got $2,000 increasing on the left side of the equation and $2,000 increasing on the right side of the equation. We are in balance. You take 0 plus 2,000 for the asset side, you end up with 2,000 equals 0 plus 2,000. So our accounting equation is in balance. We've increased an asset and we've increased an owner's equity account. Next up, we have transaction number 2. And on April 2nd, the business paid cash for supplies. They paid $300 for supplies. And notice our little pictures there. The dollar bill is representing our cash account. The computer is representing our supplies account. So we start out with our balances, and that's just the ending balance after transaction number 1. So you drop those down. 2,000 equals 0 plus 2,000. Again, we're still in balance. So what happens with transaction number 2? Paid cash for supplies. Well, cash is an asset that is decreasing. So we're subtracting $300 on the left side, on the asset side of the accounting equation. But we're also increasing an asset. We're increasing supplies. So we're taking $300 out of our cash account. We are adding $300 to our supplies account. The accounting equation is still in balance. We're subtracting and adding the same amount on the same side. Nothing is going on the right side of the accounting equation. And if we bring our balances down, we see that we're still in balance. It's still 2,000 equals 0 plus 2,000. However, the transaction affected only one side of the accounting equation, and it's represented there in the middle. Moving on to more example transactions on pages 4, 5, and 6. Here we go. So an account is defined as a record summarizing all the information pertaining to a single item in the accounting equation. And the capital account is used to summarize the owner's equity in a business. So capital, owner comma capital, comes under the owner's equity section on the accounting equation, and we're going to use that coming up here. The accounting equation, assets equals liabilities plus owner's equity. And in transaction 3 on April 4th, we're paying cash. See our little repeat symbol there, paid cash for insurance, $600. And our little piece of paper there shows our repeat image that emphasizes insurance. So first things first, we need to bring our balances down from the previous transaction. Then we need to figure out paid cash. Well, if we're paying cash, we're subtracting cash. So we've got a minus 600 under assets. And then insurance is also something of value. That's also an asset. So we're adding 600 to another asset account. So our balances remain the same. And we just go ahead and drop the balances down. And even though they're the same, we still show that we had an increase and a decrease on the same side for paying cash for insurance. All right. So a common business practice in transaction 4 is to buy items and pay for them later. And so on April 7th, we bought supplies on account from vendor and it cost $800. So we're going to move our balances down again, just take them from the previous transaction, and then buying supplies. Supplies is something of value that we own. So that is an asset. We're going to increase supplies under assets for $800. And then on account, when it says on account, that's a bill that we're going to have to pay. So that's a liability. So it goes under the liability section of the accounting equation. You'll see that it's increasing on both sides. So we're keeping our accounting equation in balance. And then when we bring our balances down, we've got 2,000 plus 800 is 2,800. Now our liability section is 0 plus 800. So it's just 800. And then we just drop down our owner's equity section there for 2,000. Okay, so for transaction 5 on April 15th, we're paying cash on account to vendor. And you can pay some of this amount or all of this amount. It just depends on whatever the terms are between you and the business that you bought the item from. Our setup with vendor means that we do not have to pay it all in total. So we owe them $800, but today on April 15th, we're going to pay $500. So we bring our balances down from the previous transaction, and then we're paying cash. So cash is an asset. We decrease our asset by $500. So we've got minus 500 on the asset side. And then our bill, our liability went up to $800 when we charged that. And now we're paying some of it off. So our bill, our liability is decreasing. So you'll see we're subtracting on both sides of the accounting equation. And then when we move our balances down, we've got 2,800 minus 500. So we've got 2,300. And then in our liability column there, we still owe $300 to vendor. So we've got $300 in our liability column, and we've got $2,000 in our owner's equity column. So here we are on page 5, and we're going to start with the accounting concept, realization of revenue. And what this states is that revenue is recorded at the time goods or services are sold. And what is revenue? Well, revenue is an increase in owner's equity resulting from the operation of a business. In other words, sales. So businesses don't always collect cash when something is sold. And so realization of revenue is all about recording that sale when it's made, regardless of whether or not the customer pays you at that time. We have, again, our accounting equation. We've got assets equals liabilities plus owner's equity. And we've got transaction number 6 here. Received cash from sales, $300. So we've got our little sales picture there, and we've got our little revenue picture there to represent money coming in. And our current balances are just taken from the previous page for the end balances of transaction number 5. So we've got our end balances here, and now receiving cash. That means that our asset of cash is going to increase by $300, and then sales and revenue, that's recorded under owner's equity. So we're also increasing in our owner's equity column there. So we're increasing $300 on both sides of the accounting equation. And when we add up our balances here, we've got 2,300 plus 300 is 2,600. We go ahead and drop our liability column down because 300 plus nothing is still 300. And then we take our owner's equity, 2,000 plus 300 is 2,300. And our accounting equation is still in balance because 2,600 does in fact equal 300 plus 2,300. So we always have to remember to stay in balance. If you're not in balance and you think you recorded it correctly, then check to see why it's not, because it will always be in balance if they're recorded correctly. For transaction number 7, we want to remember that a sale for which cash will be received at a later date, a charge sale, is a sale on account. So on August 16th, we sold services on account to K customer for $500, and sold, whenever you see the word sold, that represents that you made a sale. So when we record our balances from the previous transaction, we'll see those there. And then recording a sale, remember that's under owner's equity. So we're going to increase our owner's equity column there, plus $500. And then sold services on account. So K customer bought our services, but they have not yet paid us. That is something of value to us. That's an asset. We're going to increase that $500 on the asset side. We did not get cash for that. That's not under our cash account. It's under our accounts receivable account, but they are both assets. So we're increasing 500 on that side, and we're increasing 500 under the owner's equity side. And when we add up our balances, we've got 2,600 plus 500, which is 3,100. And then our liability gets dropped down, and our owner's equity column, we have 2,800. And so it is in fact still in balance because $3,100 is equal to $300 plus $2,800. All right, on the bottom of the page here, we've got our accounting equation. Again, it's repeated often because it's very important. The repetition helps you remember what it's all about. We've also got those images that represent the different transactions below. And so we're going to go ahead and pause right here and see if you can fill in what all those accounts or what all those pictures represent. Alrighty, did you get them? Under assets, we have cash, accounts receivable, supplies, and insurance. Under liabilities, we have accounts payable. And then under owner's equity, we have investment, revenue, which represents money coming in, expenses, which represents money going out, and withdraw, that's when the owner takes money out for personal use. Did you get them all? Okay, so here we are on our 6th and final page, and we're going to define expense as a decrease in owner's equity resulting from the operation of a business. And it's important to note that all expenses affect the accounting equation in the same way. So whether you're dealing with rent expense, advertising, phone, utilities, repairs, all of those expenses are handled in the same way. So we have our accounting equation, assets equal liabilities plus owner's equity. And in transaction number 8, we paid cash for rent. We paid $600 on April 20th. And so we bring our balances down from the previous page and paying cash. That means cash is decreasing. Our asset of cash is decreasing. And then rent, just like all expenses, are found under the owner's equity side. So we decrease $600 over there as well. So when we bring down our balances, we have 3,100 minus 600. So we have $2,500 on the asset side. We bring down our liability. So we have $2,500, and it does in fact equal 300 plus 2,200. For transaction number 9, on April 26, we received cash on account from K customer. We received $300. Now, just like we could pay our liability in full or we could pay it in partial, same with a customer paying us. So they can pay some or all of the amount. Again, it depends on what the deal is worked out between the businesses, but they can pay some or all of it. We have our balances brought down from the previous transaction, and then we're receiving cash. So we have a plus 300 under our assets. And we also are decreasing an asset, their bill that they owe us. So accounts receivable, their bill goes down. So we have an increase of cash, but a decrease in their bill that they're going to pay us. And so our asset balance remains 2,500, and our other balances remain the same as well. Again, we're still in balance. We just added and subtracted on the same side of the accounting equation. Last transaction, transaction number 10. On April 29th, we paid cash to owner for personal use, $100. Remember, paying cash to owner for personal use, that is because even though the business owner, a sole proprietor, has full rights to that money, they need to keep their records separate. And that's the accounting concept business entity. So we bring down our balances. We are paying cash, so it's a decrease of $100. Our withdraw or the personal use is under owner's equity, so we decrease 100 there. And then we take our ending balances. We've got $2,400 in assets. Our liabilities hanging out at 300. And then our ending balance for owner's equity is $2,100. So one last time, $2,400 does in fact equal $300 plus $2,100. Our accounting equation after 10 transactions is still in balance. At this point, you can go ahead and return to your pages and color code and or add anything in the margins or on the back that you'd like. I hope you found this helpful, and thanks for watching.